Under trade. Stop. What if I told you the way you've been using order block is completely wrong? Because the real secret behind order block isn't what most of your forex traders teach you, and it is the reason you traders have been getting losses and your trade has been getting weak, then going into the direction you've projected. Today, I'm going to be revealing the true meaning of order block, the way institutions use them, and by the end of this video, you will know the spot, the exact zones banks use to make billions. In this video, I'll be revealing the secret behind order blocks your YouTubers and your forex gurus does not know and are not going to teach you. So let us dive in. So before we go into the chart, let us first go into the schematics of today. So what is an order block? Very simple. An order block is a last candle before a trend. It can be an uptrend or a downtrend. What do I mean? Let's say we have an uptrend like this. We have an uptrend. So the last bearish candle before, let's say this is an uptrend. So this is a candle. Pardon my chart, pardon my drawing. So the last bullish candle before this move up is the order block. This is the order block from here to here. So there's another bearish candle rather here before this push up. This is the order block. Same with here, same with here. So also in a bearish environment, the last, let us use a different color. Let's say blue. So the last bearish candle before the push down is the order block. The last bearish candle before the push down is the order block. Now you know. I'm not going to be going into the rules of order block because I assume that you must have known the rules of order block. But if you don't know, I will just specify them here. Probably I'm going to make a separate video on the rules guiding an order block. Number one, an order block must have a fair value gap. What do we mean by a fair value gap? That is, when you have a series of like 3 candles, 1, 2, 3. So the first candle, the bottom of the first candle, this is the bottom of the first candle, and the high of the third candle, in as much as they do not meet. Can you see? This did not meet. So the line, the space in between them is what is called fair value gap. Okay, yes, that's a fair value gap. So that's what we call the fair value gap. So number one, it must have a fair value gap. That's number one. Number two, it must lead to a break of structure. This is an example of a break of structure. This is a swing low. This is a swing low, and this is a swing high. This is a swing high right here because this is a candle here. This is a swing high. So the market have to break this swing low for us to consider it a BOS. That is a break of structure. So what the market did? Market comes back and what? And go through it. So this is a break of structure. So if this order block, this last candle, this last bullish candle before this push down, provided it has a fair value gap, let's say it has a fair value gap around here, and now it leads to a break of structure, it has met a criteria of a fair value gap. The same thing also for a bullish trend. This last let me change the color again so that we don't get confused. This last bearish candle before this push up, in as much as it has, let's say it has a fair value gap around here, then it is valid. Okay, and this is the swing, high. So market comes back there and it read it up. Okay, it read this high right here, so making it valid, making this order block right here valid, and provided it has a fair value gap also. Okay, yeah, that is this. So now you understand that. So but this is not the secret I'm going to show you because this is general. Now what is the secret? The secret behind order block is liquidity. Hold on, I know you must have heard about liquidity, but this Trust me, this is very, very different. So what do I mean by liquidity? Now, an order block must take liquidity above and must have taken liquidity above and must have created or engineered liquidity below. Now let me explain what I mean. So let's say this order block, this is another block, market is moving this way. Then we have a candle here, the last bullish candle right here, that's this week. Then we now have, you know that it won't stand alone. We have some other candles also that will be here also. Some last candles, some other candles too that will be here. Okay. Now these two they have this week. They have this week also. You understand? So this order block that we'll be using, it might even have another order block here. It might even have another candle right here. Okay. But this is the other block. This right here. This right here. What did it do? You can see it sweep the high of this previous candle. It sweeps the liquidity. It sweeps the high, that is the liquidity that this candle created. It sweeps it. Okay. So once it sweeps it, and this candle also could not sweep the high of this other block, so which means that it validates this high, this other block right here, meaning that any liquidity that is above here, this other block has swept it. Why this sweep? What is the importance of this sweeping? It's going to give you the confidence that if market is going to come back right up, market does not have any business to go beyond this again, because this is what we call a protected liquidity. Okay, so market will not come back and what? And raid that high, then by pips, then begin to move down. This is what happens to most of your trades. That when you place the order block, hey, this is another block, it has fair value gap, it has a BOS, so market is a sweet spot. Then you see the market will just come back. It's my raid is by pips or by a few pips, then you see it coming down, and then you say, oh no, I envisioned this, I saw this. This is what is. Then you keep on making the same mistake, and you wouldn't know that because you are missing out on this simple secret, which is liquidity. It must first rate liquidity, so by and create a protected liquidity. So that protected liquidity, it is what is going to make you know that market would not have any business to come and raid that high any longer. So it is going to come down. That's step number one. Step number two is that it must also create a liquidity below it. It must also have or engineer liquidity. What do we mean by that? Let's give another example. Now look at this. Look at this. Now there's another block here. There's this another block. It has swept the liquidity and created this protected liquidity, right? Now, so we can be sure that it's not going to raid past the bot. It must also create liquidity below it. Now this liquidity can be in form of a double top, a triple top, or a trend line. Let's say this is top. Let's say it does something like this. Now what is it doing? It is creating or engineering liquidity below this. What is the significance of the liquidity it is creating? The significance of liquidity it is creating is that it is validating this order block. I repeat, it is validating this order block, that this order block is being validated. It is being authenticated that this order block is authentic. That is, this is the order block that market is going to come and use, and because it has swept liquidity above and it has created a protected liquidity, market does not have any business to go above this level. So your stop loss will just be above here, then should see a free fall. So market will come down and clear the liquidity that it has created around here, then use this other block to move down. It's as simple as that. Okay, let us look in a bearish scenario so that we don't just. So in a bearish scenario, market moves up Okay, so let's say it's in this place, it's created an order block. Okay, same thing. So right here we have some other candles also, so but provided this candle clear the low of this previous candle, it might have some other candles here also, it doesn't mean, but it is, so it is not, so it's, then this candle too did not read the low. Okay, so this candle read, because it traded every liquidity that is here. So even this new candle that was here could not read the liquidity it created. So since it did not read the liquidity created, it makes this place a protected liquidity. Okay, so market does not, if market is coming back down, you can be sure that this liquidity it has raided, it has swept. So there is no more liquidity that market needs to come and raid again before moving up. Okay, so then we expect a creation of liquidity. This time around, it's creating a trend line liquidity. Look at this, is a trend line liquidity. So it might even do something like this. Then market, you can expect market to come down, clear all this trend line liquidity that has created, then use this other block as the point of, as the PO high, to then continue the upward movement. So the secret behind order block is simply liquidity. The order block must first of all sweep liquidity above, then create liquidity below, or sweep liquidity below, then create liquidity above. You understand that in a bearish scenario, the order block will sweep liquidity above, then create liquidity below, which is this kind of, in this scenario here, this is a bearish scenario. And in a bullish scenario, the order block is going to sweep liquidity below, then create liquidity above. Then you expect market to come and take those liquidity, then move back in the direction. Okay, so that is the secret of order block. Now you understand why most of your trades are getting weak. Then immediately it gets weak, then you see that it starts going in your direction, because you are not considering the liquidity that the market or the order block needs to sweep first. Okay, so this is the schematic. In the next video, I'm going to be making a chart example. We'll be looking at some examples on charts on how these things play out in real time. I hope you get value in this video. If you get value, make sure you give me a thumbs up and subscribe to this YouTube channel for more educating and trading content. There will be more content that will be dropped here every week. Until next time, keep trading and see you on the profitable side.